camera fades into a series of flashing red screens, bringing the focus to a dramatic spike in the 30-year Treasury yields, which jumped to 4.82%. This follows a significant auction in which $25 billion worth of bonds fails to attract sufficient demand. Reuters reports that the bid-to-cover ratio, the lowest it's been in nearly 2 years, is an alarming sign for investors. The impact is immediate. For the U.S. government, this means higher borrowing costs, a burden it has to bear as it struggles to meet its financial obligations. For the investor community, it signals growing unease, as even the world's most liquid and traditionally safe market, the U.S. Treasury, now presents a more hesitant outlook. The surge in 10-year Treasury yields mirrors the movement in the 30-year bonds, reaching 4.24%. This rise leads to an increase in mortgage rates, affecting any loan tied to these benchmarks. Bloomberg highlights that yields have remained above 4% for 3 consecutive years, a stretch not seen since the days leading up to the 2008 financial crisis. Treasury Secretary Scott Bessent isn't raising new funds for major infrastructural projects. Instead, he's refinancing old debts, rolling over obligations in a cycle that's beginning to quicken. It's a treadmill of debt, and it's picking up speed. At the same time, the labor market shows signs of slowing. Initial jobless claims climbed by 7,000, reaching a total of 226,000. Under normal circumstances, such data would likely push yields down. But this time, yields continue to rise. Productivity data tells a different story, a 2.4% increase in the second quarter, traditionally a figure that would cool inflation fears. However, yields stubbornly ignore this positive development. MarketWatch observes that the bond market is sending a concerning signal, one that suggests a diminishing effectiveness of the Federal Reserve's rate cuts. The days when economic data could stabilize market sentiment seem to be over. Then a policy shift. The U.S. Customs Department announces new guidance imposing a 39% duty on 1 kilogram and 100-ounce gold bars. This new tariff affects imports from Switzerland, a key player in the global gold supply chain. Reuters notes that Switzerland exported 7.8 billion Swiss francs worth of gold to the U.S. last year, but that channel of trade is now under threat. Hedge fund investors, who traditionally flock to gold when treasury markets wobble, now find that the cost of hedging with gold has increased. The reaction is swift. Gold futures spiked to an all-time high of $3,534 per ounce, and the spread between futures and spot prices widens significantly. Traders describe this as a stress fracture, a disconnect that undermines confidence in the market's benchmark prices. The Swiss Precious Metals Association issues a warning, saying that tariffs will severely disrupt the global flow of bullion. This disruption is more than just a hiccup in the precious metals market. It hints at the destabilization of a pillar of the financial system. Meanwhile, American consumers feel the strain from another direction. A poll conducted by the Associated Press shows that 53% of households identify rising grocery prices as a major source of economic stress. Though food inflation has slowed from its 2022 peak, prices for essentials like beef, coffee, and orange juice remain elevated. Tariffs on imported goods play a role in this sustained inflation. As economist David Ortega of Michigan State University points out, in response, the U.S. Treasury attempts to tap the market again, announcing a record $100 billion sale of 4-week bills. MarketWatch describes this as the largest attempt at short-term borrowing in history. But while these bills may buy the government some time, they also highlight a worrying reality. Each month, that pile of short-term debt must be refinanced at the prevailing market rate. The Treasury may stabilize its immediate needs, but it only amplifies the risk of future instability. Europe is no refuge either. Despite 8 rate cuts from the European Central Bank, long-term yields in Germany, France, and the UK continue to rise. Analyst Barron notes that Europe's central bank tools seem increasingly blunt, leading to the logical conclusion that if Europe can't tame yields, the Federal Reserve will struggle to do so as well. Evidence is mounting that long-term bond markets are no longer responding to traditional monetary policies. Global markets are in a state of flux, with buyers demanding higher yields to hold sovereign debt, raising questions about the credibility of major economies. The White House, however, defends the tariffs, framing them as a strategic move. President Trump invokes the legacy of Alexander Hamilton, who used duties to raise revenue and protect American industries. Yet the tariffs are no longer confined to trade policy. They are used as foreign policy leverage. Tariffs on India for purchasing Russian oil, on Europe for subsidized steel, and on agricultural imports are all framed as efforts to assert American power. But the retaliation is swift. Trade partners reduce their purchases of U.S. goods, leading to sagging export numbers. What was meant to assert dominance ends up eroding demand for American-made products. The impact on the market is profound. After the gold tariff threat, the president walks back the policy, tweeting that gold will not be subject to the duty. Gold futures drop by 2.4%, and spot prices follow suit, easing by 1.2%. The Guardian describes it as a collective sigh of relief, but the damage is already done. Even the mere threat of tariffs has shaken confidence in U.S. policy and caused widespread shifts in hedging strategies. The U.S. Treasury continues to issue more short-term bills, but with tepid demand, yields continue to climb. Even as labor data weakens and productivity rises, yields show no sign of coming down. The traditional relationships between economic indicators and bond market behavior are no longer holding. The feedback loop is broken, and investors are left wondering if the world's safest asset no longer responds to the forces that once ensured its safety. What can be relied upon? Behind the flashing bond screens, another number emerges, a warning from Fitch Ratings. The agency, which downgraded U.S. debt last year, warns that continued weak demand in bond auctions could lead to further downgrades. Moody's, the last major agency to retain a AAA rating on U.S. debt, has already placed the U.S. on a negative outlook. A downgrade would trigger forced selling by pension funds and insurance portfolios, bound by rating rules impacting over $7 trillion in assets. If you found this video insightful, don't forget to hit that subscribe button. Stay tuned for more updates and content. We've got plenty more coming your way.